Alright, so this is part 2 of the overview of PNG income tax recorded lecture. Here we will cover the taxable income, assessable income and exempt income, and ordinary income, income and capital guidelines, carrying on a business, income from property, accounting for income, especially for resident, source of deductions, calculating tax payable, and interpretation of the tax legislation. So when you talk about taxable income, it is subjected to tax rates. So it will be coming from the difference between assessable income, which is, it doesn't have a specific definition on ITA, but there will be definition for gross income, assessable income, and taxable income. So assessable income against allowable deduction. So these are deductions that recognized and allowed by ITA, and of course it will be implemented by IRC, or Internal Revenue Commission. Now, as per definition under section 46 of the ITA 1959, assessable income include where the taxpayer is resident, the gross income derived directly or indirectly from all sources, whether in or out of Papua New Guinea. So in tax lingo, they call it taxable world. So meaning any income you derive anywhere else, even outside Papua New Guinea, will be subject or will be classified as assessable income. Now, if you are a non-resident, the taxable or the assessable income will be, or the gross income will be, only derived from all sources in Papua New Guinea. Now, assessable income shall not include exempt income. Now, when we talk about exempt income, it means that the income that is exempt from income tax or salary or wages tax, and includes income that is not assessable income. So, how to determine whether the amount is assessable or not? The questions will be like, does it fall within the definition of income as determined in judicial cases? That is it income in the ordinary sense? So there are relevant case laws which will support or which will help you to determine whether the income is assessable or exempt. If the receipt is not ordinary or ordinary income, you then need to consider whether the receipt is specifically made assessable under the Act. So this is what we call statutory income. This income are specifically mentioned by ITA 1959. So you also need to consider the residency and the source. And the next question is the amount exempt income. Now, the definition of ordinary income shall be referred to court guidelines. So, included in this presentation, there will be certain case laws that can help you to determine whether the income is ordinary. So, here, income is a receipt which is realized and derived beneficially by the taxpayer. So, if you receive it, and it is for your benefit, then that will be considered as an income. Every receipt will be either income or capital. So you have to determine which is capital and which is income. So we use the fruit or tree analogy here, in Eisner versus Macomber case. Income is the fruit while the capital is the tree. Income categories. Is it income from property? Is it income from personal exertion? Or is it income from carrying on a business? So when you talk about income from property, that includes, of course, rent income. Okay. Income from personal exertion, that will include salary and wages. And then income from carrying on a business, that will be the profit when you operate your business. Income must be received as income in the hands of recipient. So that's one thing. Another one is income is usually periodical, recurring, and regular. So it doesn't mean that all income should be periodical. So it's common that income will be recurring, or sorry, income is periodical, recurring, and regular. Like for example, your payroll if you're working. Okay. Or let us say if you are a consultant, you have a recurring fee received from your client. So that's another, shall we say, thing that will consider it as ordinary income. Income must be money or is convertible into money. So again, income doesn't automatically just say money. It can be converted into money. An item will not be income if the recipient himself is its source. Okay, so if you are the same person receiving the money that you're giving, it will not be considered as ordinary income. So what is not income? First one is receipt of capital in nature. So if you receive something which is a capital in nature, for example, you receive land, or you receive land, or let us say a car, but it is not your usual line of business to have a land or a car and then sell it. So that is not income generating. That is capital in nature. So that is not considered as an income. Capital gains such as increase in value of property or stock, as they cannot be realized without conversion into cash or other property. An example, shall we say you invested your money in PNG exchange, and then the value of your stock increases. That particular value will not be considered as income, not unless you sell the stock. Then you have to determine the cost of the stock and things like that. Gifts, not considered as an income. Any benefit that is not money or capable of being converted into money. Returns from carrying on activities that are considered as an hobby. So if you are, shall we say, painting, okay, it's not actually your work. Let us say your work as an accountant, and then you have the time to paint something, or maybe a beautiful place. That is not considered, or sorry, when you sell this, okay, and you have income on that, that is not considered as an income as per taxation purposes. Now, compensation receipts merely take the nature of the loss replaced. That is not considered as an income. But if the compensation was for a loss of income, then it is income. Okay. If the compensation is for the loss of capital or personal item or items, that is not considered as an income. So these are sort of a guiding a guideline in determining whether an item is considered as an income. Another guide based on the Eisner versus Macomber case. Okay. So in the first bullet it says what is or is not income within the meaning of the amendment must be determined in each case according to truth and substance, without regard to Form P252 US 206. So that's actually the guideline. Now, what is the truth and substance? So we have to find out, in determining the income or determining whether it's not an income, what is the real purpose? Okay. So example, if you receive a car and we know that it is capital in nature, but car is considered as a payment. Okay. of the services that you provided. Okay, so that is the truth and substance. So it means that that is the income. Okay. The second bullet, it says income may be defined as a gain derived from capital, from labor, or from both combined, including profit gained through sale or conversion of the capital. So in this case, or in this case law, we know that the income can be coming from capital or from labor. Okay, so it's not limited to labor, the source of income, wherein you have to work and receive your wages. It also includes deriving a gain from capital, which, for example, the rental income that I mentioned a while ago. Now, the third bullet, it says mere growth or increment of value in capital investment is not an income. Income is essentially a gain or profit in itself of exchangeable value, proceeding from value severed from it and derived or received by taxpayer for his separate use, benefit, and disposal. So, for example, you have a property, and then there will be a revaluation of the property. This will be, of course, uh, accounting students might be familiar with that particular term, revaluation. We know that in revaluation, we only get the fair value of the property, and we try to adjust it to get the relevant price. So, and then we will record it in our accounting records and then put it in the report. But it is not considered as a capital. Sorry, it's not considered as an income, but rather considered as a capital increment. Again, it can only be considered as income if that particular property had been sold, and then you have to determine how much is the cost against the sales price. Another one is stock dividend or bonus issue. We call it or share dividend. We also call it in that name. Invoicing merely a transfer of accumulated profits to the capital account of the corporation, takes nothing from the property of the corporation and adds nothing to that of the shareholder. There will be a separate tax on such dividend, but it is not considered as an income. Okay, because it's just merely transferring the capital account or the accumulated profits to the capital account. So a separate tax will be considered in that one, but we don't consider this as income. Now, what is carrying on a business? Okay, or how does it affect the income? Carrying on a business is, of course, when you are doing business and then you're receiving something. Okay, so how do we consider that item that you receive, okay, as an income? Okay, so let's try to see factors that will be considered that you're carrying on a business. Because if you are classified as carrying or doing a business or carrying on a business, then the receipt that you receive will be considered as an income. Okay, what are the factors? The first one is profit motive. You put up a business, of course, you want to engage in making profit. So automatically what you receive will be considered as income or ordinary income. System and organization. So when you put up a business, you have a systematic or organized operation, and then you have set up time to do your business. And then with regards to books and records, you are maintaining books and records. So even if you don't actually put up your own business, but if you have this profit motive, you have system and organization, and you're keeping books, you will be considered as carrying on a business. So is it important for a taxpayer or an individual to determine if he is carrying on a business? And also, is it important to IRC? Answer will be yes, because whatever activities that you're doing, any receipt that you are receiving will be considered as ordinary income. And of course, ordinary income will be assessable. Okay, income from property, we have rental receipts. That will be considered as ordinary income. There will be three things to exist. First, the receipt must be income and not capital. The receipt must come from property itself and not from the taxpayer's labor and personal services. There must have a gain on sale of the property or tree. So example of income from property: interest, rents, royalties, and dividends. Interest is usually taxed when received, except in cases of money lending business, which uses the accrual basis of accounting. Now, accounting for income, resident. Okay, gross income of taxpayer that is included in assessable income depends on whether or not the taxpayer is a resident of PNG. So, coming back to our previous discussion, resident, from all sources, any income that you receive or derive will be part of the assessable income. For non-resident, only income that you have derived and sourced within Papua New Guinea. Now, how to determine whether the person is considered as resident as per taxation purposes? Okay, in relation to a person other than a company means a person who resides in Papua New Guinea and includes a person, so the first one is whose domicile is in Papua New Guinea, unless the Commissioner General is satisfied that his permanent place of abode is outside Papua New Guinea. So that is important. So if his domicile is in Papua New Guinea, or his permanent abode is in Papua New Guinea, then that he will be considered as a resident. Now, if you notice, it says here Commissioner General is satisfied with it, because there are chances that the person may not be staying often in Papua New Guinea, but can be still considered as a resident of Papua New Guinea. There will be a relevant case law on this. I'll include it in the attached file of this presentation or in this recorded lecture. Number 2, it says who has actually been in Papua New Guinea continuously or intermittently during more than one half of the year of income. And then again, unless a Commissioner General is satisfied that his usual place of abode is outside Papua New Guinea and that he does not intend to take up residency in Papua New Guinea. So just imagine a person, an expatriate, who will be working here in Papua New Guinea, stayed for more than half of the year. Let us say 7 months or more than 6 months. Then we can say that this person, when he earns income, can be considered as a resident of Papua New Guinea as per taxation purposes. That is different from immigration, of course. Now, who is a contributor to a prescribed superannuation fund, or who is the spouse or a child under 16 years of age of such a contributor? So if they're paying superannuation fund, spouse also paying superannuation fund, or a child under 16 years of age, okay, the person will be considered as resident. Now, the next section, it says here, in relation to a company other than superannuation fund, means a company which is incorporated in Papua New Guinea or which, not being incorporated in Papua New Guinea, carries on a business in Papua New Guinea and has either its central management and control in Papua New Guinea or its voting power controlled by shareholders who are residents of Papua New Guinea. So if the voting power is under the control mostly of Papua New Guineans, central management or the central management and control is in Papua New Guinea, and then they are operating in Papua New Guinea, Even though if they, let us say, if they don't incorporated in Papua New Guinea, they will be considered as resident company as per taxation purposes. In relation to superannuation fund, means a superannuation fund which is established or managed in Papua New Guinea. So this is with regards to paying. If they're paying superannuation fund and the superannuation fund uh, that they're paying is established and managed in Papua New Guinea, then that will be one of the factors to be considered in determining whether the individual or the company is considered as resident taxpayer. Now, with regards to deduction, source is a question of fact, okay, rather than the law. Okay. For example, the source of dividends is determined by source of profits out of which the dividend has been fined. Source of interest income, except for interest on money secured in properties in PNG, is determined by searching for real source and is to be determined by fact of each case. Now, how to calculate tax payable? Okay, so we have taxable income multiplied by tax rate, then deduct tax offsets. That will be tax payable or refundable. Tax offsets will include credits and rebates. We will be able to discuss that one along the way. So how to interpret tax? We have tax laws, that is the primary source. Then there will be precedents or case laws which will clarify certain provisions of tax laws which needs to be clarified. It will be coming from court decisions such as National Court, Supreme Court, or from UK and Australian courts. Especially case laws, if we refer to, if we don't have, and then there will be relevant case laws from UK and Australia courts, then we can use that. And then the third one, source or interpretation of tax legislation, that will be coming from tax circulars, rulings, and interpretations, from public and private rulings, and also circulars issued by IRC. And that's it for my recorded lecture. Hope you learned something.